If you are brand new to Forex, this is the only beginner guide you need. In the next few minutes you will learn how the market actually works, how a trade makes or loses money, the costs nobody warns you about, and the risk rules that keep beginners from blowing their account. Save this video, because we are covering everything from zero. Chapter 1. What Forex really is. Forex is the global market where one currency is traded for another. Every time money crosses a border, it passes through here. It is the largest market on Earth. Trillions of dollars change hands every single day, far more than every stock market combined. It runs 24 hours a day, 5 days a week, following the sun from Sydney to Tokyo to London to New York. Currencies are always quoted in pairs, like euro versus US dollar. You are never buying one thing. You are betting one currency against another. If you think the euro will get stronger than the dollar, you buy the pair. If you think it will weaken, you sell it. That is the whole game. Pick a pair, pick a direction, and manage the risk. Everything else is just detail. Chapter 2. How to read a currency pair. Every pair has a base currency, written first, and a quote currency, written second. The price tells you how much of the quote it costs to buy 1 unit of the base. So euro-dollar at 1.10 simply means 1 euro costs $1.10. The major pairs all involve the US dollar and the world's biggest economies. They have the tightest spreads and the most liquidity, so start there. Minor and exotic pairs use smaller or emerging currencies. They move wildly and cost more to trade. They are not for beginners. You do not need all of them. Master 2 or 3 major pairs first and learn how they behave. Chapter 3. How a trade actually works. Price moves in tiny steps called pips. A pip is usually the 4th decimal place, and your profit is measured in how many pips you capture. How much each pip is worth depends on your position size, measured in lots. A bigger lot means each pip moves your account more, in both directions. Going long means you buy, expecting price to rise. Going short means you sell first, expecting price to fall. In Forex you can profit either way. There are 2 prices, the ask where you buy and the bid where you sell. You always start a trade a fraction behind. Leverage lets you control a large position with a small deposit. 50-to-1 leverage means a small move creates a large gain or a large loss. Margin is the deposit your broker sets aside to keep that position open. Run too low, and your trades get closed out automatically. This is the trap that catches beginners. Leverage does not make you richer. It makes every mistake bigger and faster. Chapter 4. What actually moves currency prices. The biggest driver is interest rates. When a central bank raises rates, its currency usually strengthens because money flows to where it earns more. Economic data moves price too. Jobs numbers, inflation, and growth all tell traders whether a currency should be worth more or less. Often the central bank's tone matters as much as the number itself. Traders are always pricing in what comes next. Then there is sentiment. When traders are fearful, money runs to safe currencies. When they are greedy, it chases risk. Speculation alone can move a currency. In 1992, George Soros bet against the British pound, and the Bank of England could not hold the line. You do not need to predict all of this. You just need to respect that real forces, not random luck, are pushing every candle. Chapter 5. The costs nobody warns you about. Every trade has a cost called the spread. It is the small gap between the buy price and the sell price, and you pay it the moment you enter. On a quiet major pair, the spread is tiny, but during news or on exotic pairs, it can widen fast and quietly eat your profit. There is also slippage. In fast markets, your order can fill at a worse price than you clicked, especially around big news releases. Hold a trade overnight, and you may pay or receive a swap. a small interest charge for keeping the position open. None of these costs are huge on their own, but traded often enough, they decide whether a strategy actually makes money. Chapter 6. The order types you must know. A market order buys or sells right now at the current price. It is instant and simple. A limit order only triggers at a better price that you choose. It lets you wait patiently for your level instead of chasing. A stop order triggers once price breaks through a level, so you join a move only after it confirms. The stop loss is your safety net. It automatically closes a losing trade at a price you set in advance, before emotion can talk you out of it. The take profit does the opposite, closing a winner at your target. Set both the moment you enter and let the trade manage itself. Chapter 7. Risk Management, the skill that keeps you alive. Here is the truth most beginners learn too late. You do not survive by being right. You survive by losing small when you are wrong. The first rule is position sizing. Risk only 1 to 2% of your account on any single trade. That is it. Always use a stop loss. Decide where you are wrong before you enter, and let the market take you out automatically if it gets there. Aim for trades where the reward is bigger than the risk. If you risk 1 to make 2, you can be wrong half the time and still grow. Respect the brutal math of drawdown. Lose 50% of your account, and you need a 100% gain just to break even. And never bet the account on one idea. Even a great edge dies if a single oversized trade can wipe you out. Protecting your capital is the actual job. Profit is just the byproduct of not blowing up. Chapter 8. The emotions that wreck traders. 2 emotions destroy more accounts than any bad strategy: fear and greed. Greed makes you over-leverage, chase trades, and hold winners until they reverse. Fear makes you cut winners early and freeze on your stop loss. The best traders are not fearless. They simply follow a plan, so the decision is already made before emotion shows up. Revenge trading after a loss is where small mistakes become disasters. The market does not owe you that money back. The fear of missing out makes you enter late, at the worst possible price. Remember, there is always another trade. Discipline beats prediction. A simple strategy followed with patience will outperform a genius plan abandoned under pressure. Chapter 9. A simple strategy to start with. You do not need 50 indicators. You need to read what price is already telling you. Start with the trend. Is price making higher highs and higher lows? That is an uptrend, and trading with the trend is far easier than fighting it. Mark the obvious levels where price has reacted before. These zones of support and resistance are where good trades begin and end. Use a higher time frame to decide direction, and a lower time frame to time your actual entry. Wait for price to reach a level, then show you a clear signal like a strong rejection candle before you commit. Entry, stop, and target all decided in advance. Boring, repeatable, and far more profitable than chasing every move. 1 clean setup a day beats 10 impulsive clicks. In this game, quality always beats quantity. Chapter 10. The mistakes that blow beginner accounts. Mistake 1. Trading too big. One oversized position can erase weeks of careful progress in minutes. Mistake 2. No stop loss. Hoping a losing trade comes back is how small losses become account-ending ones. Mistake 3. Overtrading. More trades is not more money. It is usually more spread paid and more emotional mistakes. Mistake 4. Jumping between strategies after every loss. You never give an edge enough time to actually prove itself. Mistake 5. Trading big news blind. Spreads explode and stops get hunted. Let the dust settle first. Avoid these 5, and you are already ahead of most beginners who ever open an account. Chapter 11. Build your plan and get started. Start on a demo account. Trade with fake money until your process is consistent and boring. There is no rush at all. Write a simple one-page plan. Which pairs you trade, which setup you wait for, how much you risk, and when you walk away. When you go live, choose a properly regulated broker and start with an amount you would be completely fine losing. Keep a trading journal. Write down why you entered, how you felt, and what happened. Your patterns will reveal themselves. Set realistic expectations. Nobody doubles their account every week. Steady, controlled growth is what actually compounds. Master the basics in this guide, protect your capital, and you give yourself a real chance in this market. If this guide helped you, subscribe for simple, honest Forex education every week and check the channel for a short lesson on each chapter. The regulated broker and free resources I use are linked in the description. Trade safe, manage your risk, and I will see you in the next one.